Donald Trump is once again reshaping America's global energy posture, this time by leaning hard on China to walk away from discounted Russian crude and turn instead to American oil, despite the higher price tag. It's a striking reversal from the Trump who once championed unbridled U.S. oil production with slogans like "Drill, baby, drill," urging the nation to flood global markets with cheap crude. But pumping more oil was the easy part. Selling it, especially at scale and at a premium, has proven far more complicated. Rather than nurturing a network of diverse buyers over time, Washington is now attempting a bold, direct approach, targeting the world's single largest oil consumer. The pitch is simple: ditch Russia's cheaper supply and buy American. But China's reply has been equally unambiguous: not interested. As Trump amplifies pressure, the US Treasury is quietly trying to shore up domestic stability, planning to raise an additional $100 billion via short-term Treasury bills just to maintain smooth government operations. Meanwhile, Treasury Secretary Scott Basant is taking a gentler route than Trump, framing U.S. goals as a kind of economic partnership. He's suggested that China reduce industrial output to rebalance its economy, implying that less domestic production could open up more room for U.S. exports. But underneath the soft language lies a clear strategic play: securing space for American energy in global markets, a Trump-era priority dressed in diplomatic language. This dual strategy, blunt pressure paired with diplomatic persuasion, has led to a rare kind of standoff, one that underscores both the erosion of U.S. leverage and the rapid transformation of global trade dynamics. The U.S. campaign to wean China off Russian oil was always an uphill battle. Officials made strong statements, hinted at penalties, floated the idea of new tariffs. But much of it hinged on the outdated assumption that Beijing could be shamed or squeezed into submission. That assumption no longer holds. China's response has been crystal clear. Its leaders view energy policy as a matter of national sovereignty, not something to be dictated or politicized by foreign powers. And their commitment is backed by numbers. In 2024, China imported more than 108 million tons of Russian crude, around 2.17 million barrels a day. That's not a marginal supply. It's a foundational part of both China's energy security and Russia's economy. About a quarter of Russia's total oil exports are now flowing to China. The idea that American oil could simply replace that volume overnight was never plausible. Ironically, today's dilemma is rooted in Trump's own ambitions. His administration turbocharged domestic oil production, fueling a surge in shale output and promising global energy supremacy. By 2025, U.S. crude production is on track to hit record levels, between 13.4 and 13.6 million barrels a day, thanks largely to growth in the Permian Basin. Yet high production doesn't automatically translate to market dominance. Oil needs buyers, and buyers care about two things above all else: price and convenience. On both counts, the U.S. is losing ground. Russian and Iranian oil consistently sells at a discount, often $10 below Brent, and is far easier to move to Asia. Geography favors them. Russia in particular has pipelines, shorter shipping routes, and refined logistical infrastructure that slash costs and improve reliability. In 2025, Russian flows across Asia have accelerated. China's seaborne imports from Russia continue to rise. India remains a heavy buyer. Refineries across the region eagerly snap up discounted barrels. The economics are brutally simple. A refinery in Asia looking at a discounted Russian barrel versus a more expensive American one, delivered slower and at greater cost, won't hesitate. The numbers make the decision. And it's not just about crude oil. China processes Russian barrels into diesel, gasoline, and other fuels, some of which eventually flow to Europe. The EU has tried to close this loophole by tightening price caps and refining rules, but enforcement is spotty. Russian origin fuels still make their way through third countries, subtly edging U.S. oil out of vital markets. So despite historic levels of American output, placing that oil remains a challenge. Infrastructure, refinery preferences, and pricing all work against it. Many of China's independent refineries, known as teapots, are built specifically for heavier grades like Russia's Urals. Switching to U.S. light sweet crude would require costly upgrades, reduce operational efficiency, and eat into margins. Under the G7 price cap system, Russian oil stays artificially cheap, leaving China with no real incentive to change suppliers. On top of that, much of Russia's oil moves through secure pipelines or a dedicated tanker fleet designed to sidestep Western restrictions. Payments are increasingly settled in alternate currencies via hubs like the UAE, further removing the U.S. from the transaction. Even America's once potent financial weapon, the threat of cutting countries off from the dollar-based global clearing system, has lost its edge. China has spent years building buffers, parallel financial systems, alternative legal frameworks, and trade routes designed to insulate its economy from Western pressure. The truth is, China isn't reluctantly relying on Russian oil. It's actively and strategically choosing it. This isn't just about energy, it's about influence, leverage, and the evolving shape of global power. The US, for all its production muscle, is discovering that output alone no longer guarantees influence. In a world where price, proximity, and political independence matter more than ever, even the world's largest oil producer can struggle to find buyers. China isn't just resisting pressure. It's resolutely committed to its course. The economic rationale, strategic intent, and geopolitical stakes all align, and the more forcefully Washington pushes, the more entrenched Beijing's stance becomes. What began as a confrontation over oil has since widened into a broader contest of systems and strategies. Tariffs, once seen as a blunt instrument to force China into rethinking its trade model, were raised to unprecedented levels, in some cases exceeding triple digits, but the expected collapse never came. Instead, China adapted with remarkable speed. Its factories remained open, exports kept flowing, and the initial disruption faded into the background. By early 2025, China's economy was no longer in recovery mode. It was regaining momentum. In the first quarter, GDP grew by 5.4% year-over-year, beating expectations. The second quarter followed closely with 5.2% growth compared to the previous year, and a solid 1.1% rise from the prior quarter. Industrial output surged 6.4%, while manufacturing climbed 7.0%. Strategic industries outpaced even those figures. Equipment manufacturing leapt 10.2%, high-tech output rose 9.5%, and software and IT services soared 11.1%. The expansion was broad-based. Leasing, logistics, business services, and transport all grew rapidly. On the consumer side, retail sales strengthened, with goods up 5.0% and services increasing by 5.3%. Trade figures told a similar story. July's data exceeded forecasts, with exports rising 7.2% year-on-year, and imports climbing 4.1%. A significant portion of that was due to exporters accelerating shipments in anticipation of further tariff hikes, yet the impact was undeniable. In the first half of 2025, China recorded a record trade surplus of $686 billion, a staggering 34% increase over the same period last year. This rebound wasn't incidental. Beijing didn't just absorb the pressure, it redirected it with calculated precision. Its response was multifaceted, imposing counter-tariffs on politically sensitive American industries, strengthening ties with emerging markets across Asia, Africa, and Latin America, and introducing domestic support policies designed to protect exporters. These included access to low-cost credit, incentives for inventory flexibility, and pricing strategies that kept factories running regardless of external turbulence. The result? Washington's strategy faltered. Instead of reshaping China's economy, the tariffs ricocheted, raising costs at home while failing to trigger any structural reform abroad. By mid-2025, US officials had begun to quietly retreat. Tariff hikes were postponed, some reversed, and temporary deals were floated in an attempt to ease tensions, not out of confidence, but from growing recognition that the approach wasn't delivering the intended results. Yet the pressure hasn't disappeared entirely. In recent remarks, Secretary Basant introduced a new suggestion, framed diplomatically as helpful advice, urging China to scale back its manufacturing output, ostensibly to address overproduction. But the subtext was clear. If China makes less, perhaps the US can start regaining the ground it has lost in the global manufacturing race. That scenario, however, remains unlikely. China now produces nearly 30% of the world's industrial output, a dominance built not just on scale but on integration and efficiency. In sprawling industrial zones, suppliers, engineers, and manufacturers operate in close quarters, accelerating iteration cycles. A part can be designed, tested, revised, and rolled into production within days, a pace impossible to replicate in the US, where supply chains are fragmented and processes slower and costlier. This ecosystem wasn't assembled overnight. It's the product of decades of deliberate infrastructure investment, skilled labor development, and long-term industrial policy. Even if China decided to reduce production tomorrow, no country could rapidly step in to fill the gap. That kind of transformation would take years, requiring new urban centers, trained workforces, integrated logistics networks, and an entire strategic shift. Meanwhile, Washington faces mounting fiscal challenges of its own. The upcoming $100 billion tranche of short-term Treasury bills, one of the largest in recent memory, is a clear sign of the government's deepening reliance on debt to sustain its momentum. Officials are banking on continued investor appetite, but each new auction adds pressure to an already strained financial system. Higher interest rates loom, and long-term concerns over debt sustainability are becoming harder to ignore. Amid all this, geopolitical maneuvering continues. President Trump's impending meeting with Vladimir Putin has drawn global attention, not only for its symbolism but for its potential economic implications. If the two leaders can stabilize oil markets, or even project the appearance of coordination, inflation could ease, investor sentiment could improve, and the U.S. economy might gain a much-needed lift ahead of a volatile election season. What's unfolding isn't just a story about trade policy or energy supplies. It's about global influence, national priorities, and the shifting architecture of a multipolar economic order. As Washington continues to exert pressure, Beijing pushes back, and so far, with more effective results. The landscape is evolving, and the balance of power is tilting. If you want to keep pace with these changes, and understand the forces shaping the next phase of global realignment, now is the time to pay close attention. Because the next shift may not just alter trade flows or stock charts, it may redefine how we see the global economy itself.